Bismillahirrahmanirrahim. This is the second video on budgetary planning. In the first video, we talked about benefits of budgeting, essentials of effective budgeting, and budgets that comprise the master budget. In this video, we will describe the sources for preparing the budgeted income statement and explain the principal sections of a cash section. Finally, we will solve the exercises comprehensively. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all your questions, comments and suggestions, please put them in the comment section below, and for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We hope this video helps ACCA, AICPA, CPA, and CMA aspirants. We also hope that this video helps fresh graduates who have joined the companies and want to refresh their learning of budgetary planning. Let us start with the sources for preparing the budget income statement. A budgeted income statement, sometimes called a budget income statement, is a document that helps estimate and evaluate a business revenue and expenditure. It's a planning tool many companies create at the beginning of the fiscal year as they develop and finalize their annual budgets. It is an important end product of the operating budgets. It indicates the expected profitability of operations for the budget period. It provides the basis for evaluating company performance. The budgeted income statement is prepared from various operating budgets, and let us look into an illustration. To find the cost of goods sold, it is first necessary to determine the total unit cost of producing one unit as follows. We have the cost of one unit over here. We have direct material. Quantity consumed for one unit is 2 pounds and unit cost is 4. So the total direct material cost for one unit is 8. In the same way, direct labor consumed is 2 hours and the unit cost for direct labor is 10. So the total cost is 20. Manufacturing overhead is 2 hours and the unit cost is 8. So the total is 14 and the total unit cost is 44. Second, determine the cost of goods sold by multiplying the units sold times unit cost. The unit cost is 44 and so assuming that the units sold are 15,000, so the total cost of goods sold is 660,000. All data of the income statement come from the individual operating budgets that we have talked about in the first video, except the following, that is the interest expense that is expected to be 100 in our case, and the income taxes that are estimated to be 12,000. So we have the sales minus cost of goods sold. This gives us gross profit, minus selling and administrative expenses gives us income from operations. Then we subtract the interest expense and we get the income before income taxes, and then we subtract the income tax expense, and finally we get the net income. Let us look into an illustration. North Company has completed all of its operating budgets. The sales budget for the year shows 50,000 units and total sales of 2,250,000. The total unit cost of making 1 unit of sales is 25. Selling and administrative expenses are expected to be 300,000. Income taxes are estimated to be 210,000. Prepare the budgeted income statement. So we have the sales, and the sales is of 2,250,000. The cost of goods sold is 1,250,000. So the gross profit is 100,000, 1 million. And from this we are going to subtract the selling and administrative expenses of 300,000. So the income before income tax is 700,000, and the income taxes are expected to be 210,000. So we have the net income of 490,000. I have put this information in an Excel sheet in case you find my handwriting difficult to read. Let us look into another illustration. Dalby Company has accumulated the following budget data for the year 2014. Sales is 30,000 units. Unit selling price is 85. The cost of 1 unit of finished goods, direct material 2 pounds at the rate of 5 pounds, direct labor 3 hours at the rate of 15 per hour, and manufacturing overhead of 5 per direct labor hour. Inventories beginning is 10,000 pounds, ending is 15,000 pounds. Selling and administrative expenses are 200,000. Income taxes are 30% of income before income taxes. So we have to prepare a schedule showing the computation of cost of goods sold for the year 2014. So first of all, let us go into how to calculate the cost of goods sold. And we have direct material 2 pounds at the rate of 5 per pound, that makes it 10. Direct labor 3 labor hours at the rate of 15, that makes 45. And manufacturing overhead is 5 per direct labor, so that makes 15. So the total manufacturing total cost of 1 unit is 70, and the total cost of finished goods is 2,100,000. And because we have the unit sold as 30,000. Now we next they say prepare the budgeted income statement. So this is the budgeted income statement. So we have sales, and sales is 30,000 units at the rate of 85, that makes 2,550,000. Cost of goods sold is 210,000. Sorry, 2,100,000. So that makes 450,000 as gross profit. Now selling and distribution expenses are 200,000. So the income before income tax is 250,000, and then income tax are 30% of income before income taxes. So 30% of 250,000 is 75,000, and the net income will be 175,000. Once again, I have put this information in an Excel sheet, and please, this is a minor correction. This is not cost of goods sold, but this is the budgeted income statement. So let us now talk about how to prepare the financial budget. A financial budget, a type of master budget in budgeting, means predicting the income and expenses of the business on a long term and short term basis. Accurate cash flow projections help the business achieve its targets in the right way. As stated in the first video, financial budgets consist of capital expenditure budget, cash budget, and budgeted balance sheet. However, in this video, we will talk about cash budget and budgeted balance sheet only. Now, cash is vital for any business. That's why this budget is often considered to be the most important financial budget. The cash budget shows anticipated cash flows. The cash budget contains the beginning cash and ending cash balances, and the three sections: cash receipt, cash disbursement, and financing, as shown over here. The cash receipt section is cash collections from customers and other cash receipts such as royalty income and investment income, etc. The cash disbursement section comprises all cash payments made, and the financing section, which provides a detailed account of the borrowings, repayments, and interest payments expected during the budgeting period. A budgeted balance sheet is a financial document that presents the estimated value of a startup's assets, liabilities, and equity in the foreseeable future. Let us solve some exercises. Bruno Industries expects credit sales for January, February, and March to be 200,000, 260,000, and 300,000. These are the sales, and it is expected that 75% of the sales will be collected in the month of sales. So the January sales, we are going to collect 75. So 75% will be 150,000. For February sales, the 75% will be 195,000, and for March sales, 75% will be 225,000. Then, and 25% to be collected in the following month. So 25% of 200,000 will be 50,000. 25% of 260 will be 65, and obviously we have to prepare it for 3 quarters, so we are not going to go for the remaining 25%. And the total collection for January is 150,000. For February it is 245,000, and March it is 290,000. Once again, I have put this solution in an Excel sheet, and let us solve another illustration, another exercise. Denner Company expects to have cash balance of 45,000 on January 1. So we have a cash balance of 45,000. Relevant monthly budget data for the first 2 months of 2014 are as follows. Collection from customers for January is 85,000, and for February it is 85,000 and 150,000. Then payments for direct material for January it is 50,000 and 75,000 in February. Direct labor is 30 and 45. Manufacturing overhead are 21,000 and 25,000. These costs include depreciation of 1,500. Now depreciation is a non-cash expense, so we will not include in our disbursements. We will be subtracting from 21,000 as well as 25,000. So the total will be 19,500 and 23,500. Then we have selling and administrative expenses of 15,000 and 20,000. So we have 15,000 and 20,000. These costs are exclusive of depreciation, so we haven't subtracted anything from here. They are paid as incurred. Sales of marketable securities in January are expected to realize 12,000 cash. So we'll be selling marketable securities for 12,000. So that will be a receipt of cash. And now we can make a total. So the total over here cash receipts will be 97,000. And then the total available cash, we will add the beginning cash balance as well, that is 142,000. The total disbursements are 114,500, and this is our available cash and this is our total disbursements. So we have excess cash of 27,500. Now, the company wants to maintain a minimum monthly cash balance of 20,000. So we have a balance of 27, so we don't need to borrow or make any repayment. So the ending cash balance is 27,500, and this ending cash balance becomes the beginning cash balance for the month of February, and the total receipt for the month of February is 150,000 plus the beginning balance will make the total available cash as 177,500. The total disbursements for the month of February will be 163,500, and we have excess cash of 14,000, that is total available cash minus total disbursements. Now since we need a balance of 20,000, that means we are going to borrow the balancing figure of 6,000. There will be no repayments, and the total, now you can see the ending cash balance is 20,000. Once again, I have put this calculation in the Excel sheet, and if you find difficult to read my handwriting. Let us look into one more exercise. and Aaron Corporation is projecting a cash balance of 30,000. So we have a cash balance of 30,000. Aaron's schedule of expected collections from customers for the first quarter of 2014 shows that the collection will be 180,000. So we have collection of 180,000. The schedule of expected payments for direct material for the first quarter 2014 shows total payment of 41,000. This is for direct material. Other information gathered for the first quarter is sale of equipment for 3,000. So this is a receipt of 3,000 because of sale of equipment. Direct labor is 70,000. Manufacturing overhead is 35,000. Selling and administrative are 45. Then purchase of securities is 14. So the total disbursements are 205,000. Now we have the total receipt of 183 and the total available cash is 213,000. Aaron wants to maintain a balance of at least 25,000. So we have an excess of available cash 213 minus 205, 8,000. We need a balance of 25. That means the company must borrow 17,000 to have a ending cash balance of 25,000. So this completes our discussion on second part of budgetary planning. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Thank you so much and happy learning.